Staying with us, ladies and gentlemen, and joining us for our second leg of the Retail Summit conversation. This time we're taking a look at the expansion, retreat, or entry. Where are the next markets which are ripe for investment with regard to Africa's retail opportunity? And this certainly builds up on themes that have been highlighted throughout the conference, as we heard East versus West, opportunities in the North, but also understanding the various market dynamics and maybe even looking to scale down on the size of the investments that we make and structures that we construct. Ladies and gentlemen, this next panel discussion also has a very brief presentation. Thereafter, we'll have a panel discussion for around 35 minutes, which takes us to around 3:35, moderated by Bolaji Edu, Chief Executive Officer of Brawl Property Group in Nigeria. Panelists include Andrew Robinson, Real Estate Executive at Massmart South Africa, Keta Mazibuko, Retail Executive at Standard Bank Corporate and Investment Banking, Maurice de Villiers, Divisional Director for Real Estate Development at Woolworths South Africa. Bolaji, it's yours.
Thank you. Yes, so thank you very much for coming, all of you. As introduced, my name is Bolaji Edu. I'm the CEO of Brawl Property Group in Nigeria. And this afternoon is going to be predominantly a sort of panel discussion, looking at expansion, retreat, and entry in terms of the real estate, in terms of the retail sector. We're not just going to limit it to that, because that title can be a little bit narrow, given all the changes that's been happening in retail over the last sort of 10 or 15 years. So putting it into a sort of global context, retail has changed in a global basis over the last sort of 10 and 15 years. Partly due to some of the economic challenges that have been faced across the world, with falling living standards and squeezed consumer spending, but also partly due to sort of changing patterns in the way people live, and so technology as well. E-commerce, people are using retail as a source of as your main leisure activity. People want a broader customer experience, when they go into their stores. They're just not looking simply to go in, pick up their goods, and to leave again. Bringing it sort of closer to home, in Africa, we've had up until sort of 2014, 2015, there'd been sort of 10 or 15 years of very strong economic growth, across Africa, probably primarily led by the commodity-rich countries. The economic challenges have hit GDP, it's hit purchasing power with the fall in a lot of the currencies. I'm from Nigeria, and I can see the impact of the fall in the Naira has had. And it's also hit, disposable income. But, looking at Nigeria in particular, we still see that, companies or retailers are still looking to enter into the Nigerian market. You've got Pick n Pay from South Africa looking to enter. Miniso, which is a Japanese retailer, have just opened their first store. Havanias, what do they do? Havanias, Slippers, are looking to take a few sort of pop-up stores also in Nigeria. So, and I think this is a similar pattern to what's happening across the board, where things are changing, and maybe in the size of size of units that people are taking. Whether they're focusing on one or two core stores and core malls in key destinations, or whether they're going as far and as wide as possible. So I will leave that to the experts on my left here to answer that as far as possible. So, we'll just sort of kick off the question. We'll initially sort of start with, how our panelists think is the most sustainable model for entry into the sub-Saharan African markets. So we'll start firstly with Andrew for Massmart.
Thanks, Balaji. So I think the model is something that needs to be dynamic because, typically in the past we followed developers and real estate investors, and what we found is that's all fine, and we have been very cautious with our growth over the last probably 10 years, I would think. With the maturing businesses that we have in our 5 different businesses in South Africa, what we found is that we need to look to other areas to grow. South Africa is growing at 0.2, 0.3, depending on who you speak to, %. And, the sub-Saharan African countries are looking to grow in total at 3%, but some of them are 6, 7, 8%. So I think we very, bullish on Africa still. I think we have been slow, and I know a lot of the developers and some of the people in the room have seen that. And but I think we are gearing up at the moment. I think our CEO yesterday at our results said, we're looking to open 8 stores in the next 18 months to 2 years. It'll probably be more than that. So to come back to what is the most sustainable model, I think the model at the moment, it's about rent, at the end of the day, and affordability for the store. So whatever model is going to work to give the store the most sort of affordable rental is the model that we need to follow. Now, whether that's a JV, whether that means owning real estate on our own, this might be controversial, but I think, the big malls, and I think we heard it before, the days of the big malls, of the 50, 60,000 square malls in Africa, I think are, given the tenant depth, is a thing of the past. I think what you're going to see is a lot more convenience malls. I think, for us, we've got 3 brands in Africa: Builders Warehouse, Game, and Jumbo, which is our cash and carry format. And I think our model is really focused on the mass market, and I think that is really geared well for Africa. The Game with general merch and food. I mean, our Accra store is now 42% food. And Game isn't really associated with food, especially in South Africa. It's getting there, but it's not typically associated with food. We've got Cambridge and Macro, and I think Builders is moving aggressively into East Africa. It's moving up SADC, and I think our exciting sort of brand, which caters for the 90% that Zhao was talking about previously in terms of the informal market, is our Jumbo model, which is our cash and carry. And our cash and carry business effectively sells to all the informal traders. It sells to the spaza shops, to the tuck shops, to all those guys and the resellers. And I think that business for us is very exciting. The issue with that, from a model point of view, is that business really is a high volume, low margin business that can't afford a high rental. So it cannot be in real estate that is really expensive. And so what that means is it needs to be in the more sort of low-cost areas. It doesn't need to be in a really expensive, mall. It needs to be in a shed. We're opening up a store next month in Kafui Road in Zambia, where it was an existing box that we managed to get at a really attractive rental. Hadn't been rented for a few years, and we've done a really good deal there. And that's the model that I think we're going to follow on that cash and carry business. Now, that doesn't work for private equity firms and developers because your yield just isn't there. So when you say what is the most suitable model, I think, are we going to still go into malls? Absolutely. Are we going to go into follow the private equity guys and the Navares and the Actises and the Westports and of the world? For sure, we are. I mean, I think we partners with a lot of those guys in a number of their malls, and recently in Atterbury's we've opened a lot of new stores. But there is pressure on rentals. I think there's no doubt. And so depending on how that works, I think our model going forward is going to be potentially to own our real estate and put either 2 or 3 of our brands on the same site. I think that's going to be a model that will probably work for us. It means the real estate is going to need to be potentially in areas where we can get it cheaply, which is in growth areas, not in established areas, which means we're going to have to find out where the growth areas are and create a node. And I think with those 3 brands, we can do that.
I mean, one thing which is not sort of very common in sub-Saharan Africa is the sort of the high street. I mean, there isn't really, in a lot of countries that you go to, there isn't really sort of high street trading. So Maurice, from your perspective, how are you guys sort of looking at your model across Africa? I mean, is it the the sense that as Andrew was saying, there isn't one standard model that you can adopt across the board? All the countries are very different. Nigeria is different to Ghana, and Kenya is different again.
I think our model varies from Massmart's model. Firstly, I think we in Africa, because it gives us a diversified income stream. And the second thing for us is we're trying to build critical mass in some of those markets. We have a big exposure in some of the SADC countries, and we're trying to get critical mass to offset it, because the SADC countries follows a fairly similar growth pattern than what is happening in South Africa. And we're trying to get something that's a bit more diversified, hence a key focus for us to expand, particularly in Kenya at the moment, where we have some exciting projects that's currently in the making. As to the model, we've been there, we've done it all in the sense of we had franchises, we had JV models, and we basically bought all the franchise models out and currently have one small JV business still. But I think the long-term model for us definitely is a corporate model rolling out. What impacts on us is definitely the indigenization laws and trying to get trading permits. It's a new thing that's come up, particularly in Namibia and Botswana, which is impacting on our ability to roll stores out. I think just back to the franchise and why we exited out of it, there was always brilliant franchises, but generally it was the issue about access to capital. When we wanted to roll out stores, the partners or franchisees didn't necessarily have the capital or didn't have the capital to acquire the stock or carry the sufficient stock in the stores to our desire. And I think the ownership model for us just works a lot better in the African market. I think one of the key risks for us is the dollar rentals. Some of the previous speakers referred to the dollar rentals, and I didn't necessarily on the same page. I don't think the high level of acceptance of the dollar rental, it's actually really a stumbling block for us to roll out. And we're coming to markets where we paid a lot of school fees, and we're rather steering away from signing up for dollar rental. So we are in a bit of a standoff position at the moment, and to try and find a more sustainable model. In very strong markets, you can probably enter into a dollar discussion, but as soon as you move out of the major metropoles, any dollar rental has really burnt us, and it's really the cause for us not to expand going forward. So it's a mixed bag of new criteria that we're trying to deal with and still grow profitably at the end of the day.
Thank you. And Kethu, you have exposure to a large number of retailers in your role as in Standard Bank. What sort of trends are you sort of seeing in terms of how people are looking to sort of enter countries in sub-Saharan Africa?
Yeah, certainly. I think where we get involved from a banking services point of view is definitely to this point about what is the sustainable model. So it's less around starting out initial retail. It's more kind of year 3, year 4 in terms of when a retailer needs the ability to have POS devices to collect cards or cash collection capability to collect cash, etc. So certainly we see a lot as a retailer becomes more established in the country, and then you start seeing what models really do work. I think one of the most important things is the sustainable models are the ones that are sensitive to some of these market dynamics. Most markets in Africa are bulky, lower middle. And so to the point that Andrew mentioned, I think it is important that retailers respond with the right offering in the right format. To cut and paste some of the offerings from SA, where the mature retail market that appeals more to middle and upper middle, can be difficult to get sustainability in the initial years. So that's certainly one of the key challenges, is establishing a format that is more suited to a lower middle market. I think to the point again, in terms of what is working in terms of sustainability is that if you look at the retail categories, what demand is there from consumers? So we mentioned retail as if it's one big market, but actually distinctly fashion, food, general merchandise, and then quick service restaurants. And certainly I think what's leading the demand right now is more food and actually quick service, then fashion, and then general merchandise. But we're also starting to see now a bigger demand as people are getting into homes. So there is kind of, especially in Kenya, especially in Ghana, the appliance demand and general merchandise is starting to show some real promise. So I think one of the dynamics and one of the trends is kind of balancing this demand and not necessarily taking some of the models that we have in more established markets and seeking, whether through franchisees or through their own ability to make that work. I think it's these sort of different dynamics that will make the successful model work in different countries.
Okay, thank you very much for that. Across this sort of day and a half, and especially this morning, we've heard a lot about sort of e-commerce and how that is going to impact the property industry. It's had a transformational effect in sort of developed markets, and obviously we're all aware that here in sub-Saharan Africa or parts of sub-Saharan Africa we have issues with infrastructure and transportation. But going to all three of you, one by one, is e-commerce affecting your business? Do you have a strategy for e-commerce across the continent?
Look, I think it's very different developed markets versus sub-Saharan Africa or developing or emerging markets. I think we saw yesterday in our results. I mean, Macro's online was up 46%, but that's off a really low base, and that's in South Africa. Jumia is doing it in Nigeria. They've been doing it for a while, but they still haven't turned a profit. It's still a loss-making business, and I think that's all about distribution. You've got to be able to get product. I think one of the speakers mentioned it earlier. Get product to your markets, and so do I think e-commerce is going to be a big factor on online shopping? I saw a stat the other day: 61% of Africans have access to piped water, but 93% have a cell phone. So, I think they're going to find that, they get first access to online. Everyone's on the internet. They're going to see the internet, but whether they can shop online and get access to product and get it distributed, I think is a different story. So, I think M-Pesa has changed the game, and we see it throughout our businesses. And I think that is the first step in e-commerce in terms of being able to buy without in a cashless environment. But are we concerned about e-commerce or the rollout of e-commerce in those markets at the moment? I don't think it's developed enough. I don't think the markets have the IT infrastructure yet to get there. And I don't think the companies have the distribution capability to get product to the areas that they need to. So I think we still think it's going to be a bricks and mortar strategy for the next, at least foreseeable future.
I think the e-commerce, yes, it's coming. Currently, our online sales represent hover between 1% and 2% of our total sales. If you look at some of our Australian brands, they're hovering around 15-16%. But in the South African and African context, we don't know when that deflection point is going to come. And we do expect in the rest of Africa that deflection point potentially will come and happen later. So, for us, it's still very much a bricks and mortar strategy. Yes, we're engaging. Yes, and we're heavily investing in it. But it's still early days to try and get that model to be profitable.
Yeah, I mean, I think one of the sort of leading doom and gloom anchors for the threat of e-commerce and the negative impact that it could have on real estate comes out of what happened in the States last year, where I think the different retailers closed over 3,500 stores. But if you look at the composition of who closed which store, leading the pack was Radio Shack with close to 520 stores, and then second was JCPenney. So that, I think, has less to do with retail as an entire category, but actually about those categories and those retailers. Electronics, Radio Shack, I think my DVD player and our phone have probably consolidated 4 different appliances that I used to have. I don't need a VCR, hi-fi, et cetera. You know, with iTunes Music and DSTV, that's it. So electronics has suffered in general, and therefore Radio Shack and those retailers have had to, you know, close down stores. JCPenney, I think, is probably suffering from fast fashion in terms of what H&M and Zara and the like have done. So again, not a big surprise why that has happened. And then, of course, there's a greater context of overall GDP growth in the US and Europe being flat. And so one should expect a reshuffling of the retail deck, and not necessarily because of one silver bullet called e-commerce coming to replace physical bricks. I think what we're seeing, certainly in terms of what we're trying to enable for our retail partners, is the interplay between clicks and bricks, and making sure that at the till, just like in Kenya, a customer who wants to pay with cash or card or mobile is able to have that transaction happen. But I think the bigger difficulty for retailers is obviously processing that transaction, making sure it recons in the back end. So that really is kind of the core focus. I think e-commerce actually opens up a bigger opportunity for retailers to engage with customers, get the data so you know who that customer is, you start to understand who your repeat customer is, and you can then start planning your merchandise more effectively. So if anything, I think it probably has more positive upside. And yes, we're seeing the closures, but the closures I think have it's a slightly different story. I think there's probably more upside in terms of what omnichannel and the interplay between e-commerce and physical retail have to do.
Okay, thank you. I mean, is it probably fair to say that, you know, sort of e-commerce probably has more of an impact in terms of the investors and developers as to which sectors and areas they invest, and for a retailer, your main aim is just to sell product, and whether you sell it online or whether you sell it through a physical store, that's you know, less relevant.
Well, I think omnichannel retailing is the way of the future. I think you need to be, again, it talks to the first question, which was what is the model? I think you need to be cognizant of what do shoppers want and what are they buying. I mean, in South Africa, the millennials and the younger generations are shopping more online than ever, and they're actually going and doing their searching for product online and then going to the store and going to buy it. And so, you know, we've got to be cognizant of that. I think we are some way away from that in some of our sub-Saharan African countries that we're in, but not to say that won't happen. I mean, I think we just need to be wary of it and understand that it's coming. And I think it's all about what does the shopper want, and giving the shopper what he wants. And if it means it's convenience, or it means, you know, it's price, or whatever it is, I mean, that's what we need to do.
I think from our perspective, the impact of online is really what concerns us, is this concept of being caught in the middle. So we know what ultra convenience is going to look like and what it should look like. We know what big brand building stores, for example, if you take into Sandton, what it will be. So in 10 years' time, it will still be your big dominant store, and that's where you'll spend all the money and put your best foot forward in those kind of centers. But it's the centers in the middle that's neither dominant nor convenient, and what do you do with them? And I think that's what we're grappling with. And as those leases come up for renewal, we're trying to reflect about how do we get more flexibility into the system so that we are more agile to be able to deal with it when the deflection point comes. So we do expect it to come. The question is just when and how many years away it might be, and that's unclear. And I think the risk lies in the properties that's caught effectively in the middle.
Yeah, I mean, I really have to echo your comments there, Maurice. I think the challenge is less around sort of outright retreat and more around balancing. And to the point about balancing this convenience and the dominant retail, I think even more so, it's also the balance in the back end and the front end, because the logistics investment is growing. So we're seeing more retailers investing more in DCs as e-commerce and as general retail changes, as you get these bigger concentration points across different countries. So, you know, there's investment in real estate in that part of the value chain, as well as in the front end in terms of the stores. But certainly, I think part of that challenge is as convenience grows and more that brand experience that millennials demand. That, I think, is where the challenge will be for landlords and for retailers, because where you could afford to refurb every 5 or 7 years, you're now going to have to refurb a lot more seasonally and activate around your store a lot more seasonally, because the customer is expecting you to be magical every single experience they have. And so I think, what you do in terms of storefronts and shop fittings, it's the durability and the extent to which it actually looks across the board. So I think there was very much a distinct difference between luxury retail and value retail. I think what you're seeing now is that's starting to kind of blur a little bit, where retail is providing better experiences. And so that forces a bit of, a lot more rebalancing of the estate and focusing on where you're going to have a store and making sure it's a rich experience.
Okay, one sort of final question before we sort of open it up to the audience for their sort of questions, thoughts, and sort of comments. Also, I mentioned sort of earlier that a lot of countries in sub-Saharan Africa have had a sort of financial hit, over the last sort of couple of years, with reduced purchasing power, lower disposable income, and then also primarily because of falling in commodity prices, and then which has sort of led on to devaluations, which have been sort of probably more significant in countries like Nigeria than in other countries. Do you see that you're losing customers to the sort of informal market, where they've also got a much lower cost base, but they also have a much lower sort of pricing point?
Yeah, look, I think, again, it comes back to what your model is. I think as we are focused on the mass market, I think our model is well geared towards playing across those customers. So we do target the mid to sort of low LSM through our jumbo, through our cash and carry, the mid to sort of higher LSM through game and through which is predominantly general merch and food, and then builders, obviously. But, I think it's... we're not pulling out. I don't think that, we actually going quite aggressive into East Africa now. I think we've got 5 stores in Nigeria. We're looking at a number of additional stores in Nigeria. We understand, look, make no mistake, constant currency, we up, but when you convert it back to ZAR, which is what we report in, I mean, the Africa story is down. It's negative. But again, we through the cycle investors, we're investing in stores for the long term. We've been in Nigeria for a long time. We've been in Ghana for a while. We've been in Zambia for a while. So it's not that we are, I think somebody yesterday said, it might have been Martin Davies, get in, get out, get in, get out. The cost of infrastructure for a retailer to do that, it's significant. And so we're not in that movie of getting in and getting out. I think we are there for the foreseeable future, and we are rolling out stores, and I think we are aggressive. But again, it's making sure that you're in the right locations. Access is critical. Visibility is, important. It's all the normal property fundamentals that it needs to tick. I mean, it's a standard. It's everyone in this room knows what they are. But again, we think we're well geared for the mass market, to answer your question, and we're well set up for it, and we're going ahead aggressively.
I think from our perspective, we definitely see the informal market, it goes through cycles, and it's particularly in our mind driven from formal to informal by the currency exchange. So if the currency takes a massive dip, our product, we have to increase the price of our products. We drive the customers out of the formal retail back into the informal side, and vice versa. And that's why we're trying to get critical mass in most of the countries that we operate in, purely to be able to better absorb some of those shifts.
Yeah, I mean, not to sound like the naive optimist, but I think that is the opportunity in the African continent, right? Is that there is the extent of informal retail exists, and that's what creates this opportunity to establish a state and formalize the sector so that you get, the demand going into formal retail. I think that the broader challenge is what will drive these economies, what will drive that customer demand. And I think the obvious trick for Africa is, instead of where we're coming from now, where there's large exports going up north to Europe, and now the commodity countries were swinging east, is actually how do we get more exports and imports into Africa? Because that will also create more jobs and will create the level of employment that needs to happen so that you actually have rising incomes and not just dependent on the big cycles. And I think that's, at the heart of it, one of the bigger, more kind of macro political challenges that the different economies face, is that we do tend to swing too heavily towards the developed world for these commodities, whether it be agri going up to Europe or now hard products going up to the east. And I think there's a lot more services that actually need to flow in between SA. I mean, the lawyers, I think, are starting to lead the fray, which is different for lawyers to take that risk. But I think, the accountants, financial services, telecoms, all of that actually needs to play a lot stronger. South Africans going to Kenya, Kenyans going west. That is actually what's going to sustain, I think, a lot more stable consumer market overall, as opposed to then being subject to these swings that we're seeing happening.
Okay, thank you all very much. I think we have just over 5 minutes, and we'd like to just open it up to the floor and see if there are any questions, comments, observations that they would sort of like to share with the panel and with everyone else here in the room.
That's what happens after lunch.
Yeah, it's a great graveyard slot. Everyone is still so tired after lunch and after a long day and a half. Okay, there will be a microphone coming. A microphone will be coming around shortly.
Sorry, I just got one question. One of the previous panelists alluded to the tax rebates that would be given by the likes of Turkey to the retailers that were moving outside of Turkey to Africa. What are the possibilities of the South African retailers like yourselves sort of engaging with with our government or with South African authorities to try and work on that so that you are more competitive and are able to compete with the likes of the Turkish retailers that are going to be moving into Africa and competing on those markets? And are there any rebates that you get at the moment?
Yeah, look, I mean, I'm not a tax expert, but I think it's going to be more about if you want to be driving investment, and I think one of the economists said it yesterday, it's all about the macro policy and the policy makers and how they deal with that in their jurisdiction. So I think, if they're going to encourage investment into their country and they're willing to give those tax incentives, I think that's going to be driven by the guys in country. I'm not sure the South African Revenue Authority or the South African government are going to be giving rebates to drive product up north. For us, I haven't heard of that. It's not something that in any of our businesses we've seen. I do think, to encourage investment, the tax regimes in the various countries, and we've got a whole tax department that focuses on controversy, which is, the tax authorities in the various jurisdictions having, we struggle with the tax authorities in the various jurisdictions because they're always assessing us, and we've got to object to it, and it's an ongoing situation. I haven't to date heard of that. I'm not a tax expert though, so it's not something that I can really comment on. If the South African authorities, I would be surprised if they do though.
Yeah, I mean, certainly in terms of some of the work that we've advised our clients on, it's one of the biggest challenges on the continent is simple things like withholding tax, and I think that does prohibit more investment when either private equity is looking at making an investment, because you've almost got a double whammy. You've got the dollar issue, so you've got a mismatch in currency as well as then withholding tax. So I think it's certainly one of the opportunity areas actually for the continent to better, the governments actually coordinate a lot more effectively so that you encourage investment in retail.
Okay, so one final question.
Was the question the impact of the Turkish trade on the village? I think it's a tough one to answer because we saw the impact of H&M in the local market. It hurt most of the fashion retailers, and in some centres now it's a positive thing because it's driving more footfall through the centre, and it gives a broader range of cross-shop for potential customers. So I think overall it's a good thing. The fashion, unlike food, which is shop and convenient, fashion you need comparable other fashion stores, and the more you have of them, the better it may be overall, and it's also good for the long-term sustainability of that centre.
Okay, I think that was our sort of final question. So I would just like to thank my panelists here, Andrew, Maurice, and Kathu, for their insightful comments. And thank you all very much for cutting your lunches short and so coming here.